All right, welcome to Talk Tickers. Today we're diving into Huntington Bank's Q3 2025 earnings, and let me tell you, it was a big one. Management basically came out swinging, talking all about outperformance and hitting the accelerator. So let's just jump right in and see what's got them so confident.
I mean, look at this. Right out of the gate, the CEO, Steve Steinhauer, sets this super bullish tone. He's not just saying, hey, we had a good quarter. No, he's framing it as a launch pad. He uses words like tremendous momentum and poised to accelerate. So you got to keep that word momentum in your head because it's really the key to their whole story this quarter.
Okay, so here's how we're going to break this all down. We'll start with a quick snapshot of Q3, then dig into what's driving the growth. After that, we'll look at their guidance for the future, touch on the risks that came up, and then I'll give you our final take. Let's get to it. All right, first up, the Q3 snapshot. In the big headline here, this was a quarter of serious outperformance. They didn't just squeak by expectations, they blew past them.
So let's start with the bottom line. Adjusted earnings per share came in at 40 cents. Now, that number might not sound huge on its own, but get this, it's up 18% from last year. That is some really impressive growth right where it counts.
And how'd they get there? Well, it wasn't just by cutting costs. The top line, their revenue, was up a whopping 14% year over year. That tells you this is genuine growth, real expansion of the business.
And here's the number that really matters for shareholders. Tangible book value per share grew by 10%. That's basically the real hard asset value of the bank. So all that great performance we just saw, it's flowing directly into creating real value for investors. Love to see it.
Okay, so those numbers are great, right? But the big question is why? What's actually driving all this? Let's pop the hood and look inside the growth engine to see what management is pointing to.
So management really wanted to hammer home three key things on the call. First, their core day-to-day business strategy, it's firing on all cylinders. Second, that execution is leading to some top-tier profits. And third, and this is a big one, they see that Veritex acquisition as a springboard, not just a deal, but a launch pad to really accelerate their growth, especially down in Texas.
And you want to see what firing on all cylinders looks like? Check this out. Huntington's loan growth was over 9%. Their peers, barely 2.5%. That is a massive gap. So when they say they've massively outpaced their competition, yeah, this chart proves they are not kidding. It's a huge difference.
So let's talk more about that Veritex springboard. This deal is a really big deal for them. Right away, it gives them serious scale in Texas, making them a major player there overnight. It's also expected to make them more efficient. But the real prize? The revenue synergies. They can now go to all of Veritex's customers and offer them Huntington's full menu of products. That's a huge opportunity for growth.
So with all this good news and momentum, what did management do? Exactly what you'd hope for. They raised the bar. Let's look at their new forward guidance. And wow, they didn't just nudge it up a little. Look at this. Net interest income growth bumped up by a full 2 percentage points. Fee income growth raised. Loan growth upgraded. But the one that really catches my eye is the positive operating leverage. They basically more than doubled their forecast for how much faster revenues will grow than expenses. That is a massive signal of confidence.
And they're not just feeling good about the rest of this year, they're already giving us a peek into 2026. They're expecting their net interest margin, that's a key profitability metric for banks, to actually expand. So they're telling us they think this momentum has legs. It's not a one-time thing.
Okay, but it can't all be sunshine and roses, right? The analysts on the call definitely had some tough questions. And the Q&A really honed in on a couple of key risks that are on pretty much every bank investor's mind these days. So, question number one, the big one. What is the deal with credit quality? We've all seen the headlines about trouble at other banks, so naturally everyone wanted to know, is Huntington seeing any cracks in their own portfolio?
And management's answer was pretty forceful. They basically said, look, we've been disciplined about this for 15 years. We have a low-risk appetite. They talked about being really selective with clients. And here's the kicker. They mentioned that they actually passed on some of those specific deals that ended up blowing up at their competitors. So their message was clear. Our forward-looking metrics look fine, and we're not worried.
Okay, next big question for management. After pulling off a huge deal like Veritex, is the team going to get distracted? Are they already out there hunting for the next big thing instead of focusing on the business they just bought?
And they shut that down pretty quick. They were really clear. Their number one focus is executing on their current business and making sure the Veritex integration goes smoothly. They said they've got a lot on their plate already. And just to kill any rumors, they came right out and said we were not involved in Comerica. Message received, loud and clear.
So, let's put it all together. You've got amazing results, you've got raised guidance, and you have a management team that handled the tough questions with confidence. So, what's our take on all this?
Bottom line up front, our rating is outperform. We just think the story here is all about accelerating momentum, and we don't believe the market is fully priced in the earnings power of this company, especially with Veritex in the mix.
So our outperform thesis really comes down to three things. 1, their core business is just plain growing faster than everyone else's. 2, Veritex isn't just another deal. It's a genuine catalyst, a springboard into a great market. And 3, their conservative approach to risk acts like a safety buffer, which is exactly what you want to see in this kind of environment.
All right, so for our outrageous but plausible trade idea, how do you actually play this? Well, we think the real value unlock is going to happen over the long term as all those Veritex synergies really kick in. So instead of just buying the stock, you could consider looking at long-dated call options. Think 18, maybe 24 months out. It's a way to make a defined risk bet on that long-term upside, capturing that potential as they gain market share and really make that Texas acquisition sing.
And of course, just a quick reminder, everything we've talked about today is for informational purposes only. This is not financial advice.